If you have a non-registered account with a capital gain, there's actually a strategy that can completely eliminate the tax on that gain. And even better, not only do you avoid the tax bill, but you also get a tax credit in the process. It's a double tax benefit, and it's a strategy I find many people overlook. So in this video, I'll explain what this strategy is, who it applies to, and how you can use it to pay less tax. This strategy is going to apply to anybody that has a gain, a capital gain, in a non-registered account. So if you've made money in your RSP or TFSA, unfortunately this tax strategy isn't for you. There's other ones that we'll cover in other videos. But in this one, it's about non-registered. So if you have a non-registered investment account or a margin account, anywhere where you have a gain, that when you sell that gain, there's going to be a tax bill to pay. Now let me jump into a quick example, and then I'll talk about why this strategy works and why you need to take advantage of it. Let's say you bought stock in company ABC. In ABC, you invested $10,000, and over the last X amount of years, that's increased in value to $20,000. So you've made $10,000. Now that's a capital gain that you have not triggered. You still own the company shares of ABC, but you plan to sell them, or at least you'd like to sell them, but you don't want to pay that tax bill. Now, in the current state, if you were to sell all your shares of ABC company, you would have a $10,000 gain. Half of that, because it's a capital gain here in Canada, half of that will be taxable. Thus, you have $5,000 of extra income in the year that you sell these shares. If you're in a 28.2% tax bracket, you're going to pay about $1,410 in taxes. So it's not a huge tax bill, but as you multiply that out, maybe you're in a higher tax bracket. If you're a high income earner, paying 50% tax, now you're paying $2,500 of tax on this $10,000 gain. But let's say you invested $100,000 and it went to $200,000. Again, this can multiply and become very expensive. So what's the strategy around this? Obviously, we want that money, but obviously we're trying to avoid taxable bills. And come the end of the year, and given the great stock markets we've had for many years now, a lot of you are sitting on large gains in your non-registered accounts. And you may be at the point thinking like, oh, the market's quite high. I want to liquidate this. I want to avoid the tax bill. So one way of doing that is donating the shares in kind, meaning that you're not selling the shares, you're actually donating them out to a charity of your choice. Now, obviously the first feedback here is, yeah, but Adam, if I donate it, I don't have the money anymore. Correct, you absolutely do not have the money. The charity has the money to do whatever they're doing. And this is why you get to choose a charity of your choice and make sure that money is going to causes that you care near and dear. But here's a tax benefit. Let's go back to our example of your $10,000 investment going to $20,000. When you donate your shares in kind, that $20,000 goes fully to the charity. So the charity received your shares and the full $20,000. So when they get it, they sell it right away. But their cost base is $20,000. They sell it at that, they get the full amount. When you donate the shares, they're worth $20,000. So you're going to get a tax receipt for that donation for $20,000. Now in Canada, it depends what province and your income and all that, but let's say you're going to get about 50% back in taxes. So you're going to get a tax credit based on that donation. So of your $20,000, you're going to get about $10,000 back in your taxes. So a huge benefit there. But here's the third kicker to it all. That $10,000 gain and that $1,400 or more tax bill that you had, that is completely wiped out. It's eliminated altogether. So while it's kind of a double tax break, I like to call it a triple tax break, in that the charity gets the full $20,000, you as the donor get the full $20,000 donation credit, and CRA doesn't get anything. So for those of you that have a gain in a non-registered investment account and are looking at ways to maybe get rid of that gain, but also not pay the tax and maybe help out a local charity that you care near and dear about, this is a great strategy. And for those of you that donate money already, maybe you donate cash right from your bank account already, and you're sitting there saying, Adam, like I already donate $20,000 a year. This would be a much better way because you're saving that tax bill along the way. So if you have a non-registered account and you have the heart to give, this is a fantastic way to give money to charity, to help reduce your tax bill, to get your tax credit for the donation. And again, that full amount goes to the charity. Now, again, for many people, this helps reduce their tax bill. A lot of you aren't spending all your money in your lifetime and you're thinking of like, how do I find ways to reduce my tax bill? And so giving to charity, I think we can all agree we'd rather give our money to charity than to CRA. And so yes, we're losing control of that money, but my $10,000 initial investment, I'm getting that back in tax benefits. So it hasn't cost me. I haven't made money now on my investment, but I've also given $20,000 to a charity that can do so much with it, and I get my $10,000 back in tax credit. So it's a huge win-win. So again, if you have a giving heart, if you have some non-registered investments that have some gains, I strongly encourage you to talk to the charities of choice that you like to work with and ask them if they can take stuff in kind. Most charities will accept stocks, investments in kind. It's very simple to do. It's not a lot of paperwork, and they will handle all the work. So don't think, well, this sounds like it's a lot of work and complicated. It's not. If you want to do a strategy like this, but you don't really want to give it all to one charity, or you maybe don't have a charity of choice at this time, but you like the idea of the tax savings in the structure, you can set up what's called a donor advised fund. I do this myself. I go through a company called GiveWise, and I'll link that below. GiveWise is a great organization, and basically what happens is you donate stuff in kind to them. They're the one that provide the tax receipt to you, but your money sits there, and then you can give it out to the charities you wish over time. So I have some clients that have done this where they give a big gift, and they don't want to give that big gift at one time. They want to spread it out over time. So it's a great way to do it. So again, GiveWise is just one of the many options out there for donor advised funds. So one I use personally, I like it. Very, very low cost, very good platform. And again, it's a nice place to donate into there and then out so that you're getting one donation receipt. Because sometimes if you're donating to many charities, you're getting a lot of receipts. Again, it's kind of like RSP receipts. It's a bit confusing. So this simplifies it as well. So again, if you have any questions, put some comments below. We'd love to support you in this. It's a great cause. Coming the end of the year, we're all looking at ways, how do we reduce our tax bill? A lot of people think the stock market's high, whether it is or not. If you're looking to liquidate some of it, this is a great way to do it. Not pay the tax bill. Help some good charities, maybe locally or globally, that your heart is near and dear to. We'll see you in the next video.